Hi, so my name is Akshat, and this is the first episode of Market Musings. and this is going to be more or less 30 minutes refresher on what went on during the week. And this is my attempt to try to explain what I think and just to spread knowledge, nothing else. So let's see how it goes. And we'll iterate as we go forward. The goal is to keep this long term sustainable, so we will do it once a week or once every 2 weeks. We'll kind of decide on it, or it depends on my schedule, but let's try it. Here goes nothing. So I'm just gonna look on the monitor there because I have some notes, and I'll probably read from it. That's probably not a good sign, but whatever. So let's see. On Friday, May 2nd, because we are recording this on May 4th, so the last market opening day was May 2nd. The Wall Street extended its rally to 9 consecutive days and one of the longest streaks since 2004. And the fun part is the whole April, all of the losses triggered by the Liberation Day is now recouped, and S&P 500 is at 5,600, Dow Jones Industrial Average is at 41,000, Nasdaq is at 17,900, almost 18,000, and then Russell 2000 is at 2,000. Despite the recent gains, all of the indices are down for the year, but if you ask any economist or anyone, and if you would have told the news that, hey, these are the things that is going to happen, and the market didn't do anything literally for the whole month, except for the volatility, but it's just if you would have gone to Hawaii for, let's say, a vacation and come back 30 days later, you wouldn't have even felt anything. And that's why it is important to always or try to hold your stocks and, don't come into the hubba bubba that goes on. So let's talk about the general topics that happened this week. So these are all general, and and then we'll go into company specific news or earnings rather, and then I'll share my thoughts on how it goes, and then we'll see if we have to iterate. A growing number of investors are actively pressuring companies to adopt and integrate AI as a strategic priority. In a recent survey, KPMG said that 68% and 90%, 68% in late 2024 and 90% in early 2025 of the investors demands AI deployment in these companies, and they are especially in the companies that are generating over $1 billion in revenue, which is quite interesting as there is a theme in the market that the AI spends are going to slow down. There is no return on investment on it yet. A lot of these companies are getting pressured. So either it's a FOMO by the investors or board, or is it something that we all are missing and which is not priced in the market? The US Federal Reserve on 30th April said that the interest rates would remain unchanged, and this decision could affect companies that are particularly dealing with consumers directly, because the borrowing costs will be elevated, and all of the investments that these people have, i.e., housing, would still be dead as the market would be stagnant and people cannot sell houses to get out of mortgages. So this is in the US. On April 30th, the Supreme Court ruled that Apple has violated an order to allow the flexibility in digital purchases. I remember reading that the judge was so infuriated with Apple that she particularly said that Apple made fun of the ruling that she made, and then that's why she's not letting Apple go this time quite easy. Ouch. Then there's a U.S. export controls on AI technology. In 2025, before Biden left the office, he enacted something called the AI diffusion rules, which controls how and where advanced AI clusters can be deployed and how models can be trained. Um, Countries are now divided into three tiers. Tier 1 is US or US allies. Tier 2 is some countries which are getting these clusters but with some restrictions or quotas. And the tier 3 countries are like China, Iran, and Russia, which will not even allow to get AI chips or model weights. So it is interesting to see how the Trump administration deals with this going forward. Again, in layoff news, the layoff has been continuing since 2023, and in this part of the year, 2025 till now, the industry is experiencing major reductions in workforce. Like 28,500 tech jobs have been eliminated across 111 companies, including Meta, Amazon, Google, etc. And the CEOs have recently announced to achieve cost reductions in these companies. So specifically Intel, that was in the news because they wanted to reduce $1.5 billion in spends and wanted to implement a return to office, and that's why they had layoffs and other stuff. There's always something going on with Intel, so it needs to catch a break. In legendary investment news, Warren Buffett steps down from Berkshire Hathaway. The guy is 95, 99, 95 almost. And then he named Greg Abel as the successor. And in the first, as his parting gift, he said, the use of tariffs as a trade weapon is not good, and these policies could estrange the US from the rest of the world. He emphasized also the importance of global prosperity and balanced international trade, which he never does. I mean, he's quite a famous Democrat donor, but he never says that in his AGM. So that was quite interesting. Since we were talking about the AI boom, the global AI surge is intensifying, and all of these rare earth minerals for semiconductors and data centers are on a rise. As you all know, all the time, China controls nearly 50% of the global refined market, including 80% of processed cobalt, 65% of lithium refined, and it poses a significant geopolitical and economic risk to the US, which seems to think that China is gonna gobble up all of these materials. So let's say if it invades Taiwan, it would be hard for the US to maintain strategic autonomy. So that's why the US was seeking to get a mineral deal with Ukraine, which they successfully did. In other news, China also ordered, or Xi Jinping also ordered, for faster development of homegrown AI capabilities. And he called for self reliance, self strengthening, and leverage the national system to achieve breakthroughs, whatever that means. But it has been seen that Huawei have been advertising that their GPUs are on par almost to the H100s that Nvidia produces, and DeepSeek recently showed that you do not need as much GPU to get a thinking model. So it is quite interesting on what China is going to do, and it is a sign of China's determination to narrow the gap despite the US chip exports curbs. Okay, so let's talk about company specific news. So Google's strong performance was quite impressive in the Q1 25 results on the April 28th. Google reported that it has the revenue reaching at $90.23 billion for the quarter, representing a 12% year over year increase. It's crazy how much money they're making. And the earnings per share came out to be at $2.81, substantially outperforming the analyst estimates of $2.01. Google's core search business generated $50.7 billion in revenue, a 9.8% increase, while the cloud business continued its growth momentum by making 28% year over year growth in $12.26 billion in revenue. Alphabet also announced a substantial $70 billion share buyback program and increased its quarterly dividend by 5%. On one hand, people are saying that maybe Google is investing too much in AI, but $70 billion of share buyback just shows how much money this company is making and how much how much of a free cash machine this company is. Then the next company on our docket is Meta, and Meta reported a strong Q1 on 30th of April with revenue of $42.31 billion, up 16% year over year. You have to think that $1 trillion company is still growing at 16% year over year. and a $2.5 trillion company is growing at 12% year over year in US dollar terms. There are not many companies in the world like these. These are really the magnificent seven. The company's operating profit, Meta's operating margin, improved to 41%, up from 38% year over year, helping drive a 37% increase in earnings per share. That is crazy, 41%. And CEO Mark Zuckerberg highlighted that Meta's AI growth is to almost 1 billion monthly active users. It feels like Meta will create anything and it will reach a billion monthly active users instantly, which is crazy. But it the improve in operating margin is also, in my opinion, from reducing investments in reality labs, their Oculus investments. So it remains to be seen if metaverse is going to be a thing. Uh, but Meta also unveiled its standalone Meta AI app powered by Llama 4, which draws data from Instagram and Facebook to personalize user experiences, while also launching a Llama API for developers. Think of this: you have a billion monthly active users on your AI products, you have billions of daily active users on your products all across WhatsApp, Facebook, Instagram. Imagine the type of data you have. Because the major problem for all of these frontier AI labs is the lack of data. But Meta is sitting on a gold mine, Alphabet is sitting on a gold mine, and it's crazy what these companies can do. So maybe 10 years down the line, they would have substantially grown into this AI business with an unassailable data lead, to be honest. So the company is increasing its AI infrastructure investments and raising its capex forecast to 64 to 72 billion dollars, up from previous 60 to 65 billion dollar projection. That's again crazy. The amount of money these people are putting in for AI is the market cap of, let's say if they put $64 billion, you can create, I don't know, almost 600 unicorns in this at this price. So the AI investments is not stopping. They are truly at an industrial scale. They're like how you put power grids in a country or how you put internet cables in a country. Absolutely crazy. After that, Amazon had a mixed result where they reported its Q1 earnings on May 1st with a revenue of $155 billion and a net income of $17.1 billion with the EPS of $1.59. While these results did beat the Wall Street expectations, the stock fell more than 4% in after hours. The company saw an impressive growth in multiple segments, especially in advertisement, which showed an 18% year over year growth to $13.9 billion, and North American sales rose more than 8% to $92.9 billion. International revenue grew 5% to $33 billion, and Amazon Web Services expanded 17% to $29.3 billion, which was a bit slower than Google Cloud, but then again, Google Cloud is half or less than half the size of AWS. CEO Andy highlighted innovations including next generation of Alexa and the first launch of the Project Cooper satellites designed to provide broadband to underserved rural areas, which basically is a Starlink competitor. In other news, Tesla reported a disappointing Q1, which was quite sad, on April 22nd, and they got an EPS of $0.27 against an EPS of $0.42 and a revenue of $19.34 billion, below the expected $21.4 billion. Despite the misses, the Tesla stock surged more than 20% in the last few days as the investors focus more on autonomous vehicles and record profits in energy businesses. Samsung in Q1 25 reported a modest 1.2% rise of year over year, and a strong Galaxy S25 smartphone sales boosted its mobile division profit to the highest in 4 years. Customers are stockpiling chips and phone ahead of the US tariff help lift its earnings. However, its semiconductor division's profit fell 42%. Samsung warned that escalating US trade tariffs could cut global demand for smartphones and chips. Yikes. I do not want to be invested in Samsung right now. And then finally, let's look at Apple. This is the last line item on our day, and I would want to deep dive on it a little bit. So let's see. So financially, Apple quarterly revenue reached $95.4 billion, representing a 5% year-over-year increase and surpassing the consensus, which ranged from $94.4 billion to $94.68 billion. So the market was not expecting any revenue growth from Apple, probably 3%, and they got 5%. Cool. Their EPS, or the earning per share, set a March quarter record of $1.65, which is up 8% year over year, beating the estimated of 1.60 to 1.63. Here's the interesting part. In Apple, gross margin came in at 47.1%. And mind you, this company makes hardware, so that is crazy. And the company generated a strong $24 billion in operating cash flow during the quarter. Imagine making $100 billion of cash flow during a year. These companies are operating at a scale of a nation. Like, many countries have lower tax collection than what Apple has in operating cash flow. But let's talk about the segments. The services segment was a standout performer, achieving an all-time revenue record of $26.65 billion, up 12% year over year, driven in growth by the paid subscriptions, exceeding 1 billion subscribers, and performance across the app stores and media offerings. Mac revenue also showed strength, rising 7% year over year, aided by the new M4 MacBook Air. I think it's a brilliant laptop, highly recommended. iPhone revenues was better than anticipated. However, the wearables and home accessories segment saw a 5% decline over year. Performance in China was also flat on a currency neutral basis. So Chinese growth engine that Apple had is not doing so hot for them right now. When asked for forward guidance for Q3 FY25, Apple projected low to mid-single digit year-over-year revenue growth, and gross margin is expected to be between 45.5 to 46.5, explicitly incorporated the estimated $900 million tariff impact. So there's going to be a margin fall. There's not going to be a revenue increase. Why would you have an Apple stock in your portfolio when it's trading at 30 PE? But let's look at capital returns. So again, demonstrating the financial strength and commitment, Apple board authorized another $100 billion for share repurchases and an increased quarterly dividend by 4% to 0.26 per share. The company already returned $29 billion to its shareholders in Q2 via share buybacks and dividends. I feel like the companies that have so much cash also have the fiduciary duty to do a lot of research, because research is so scarce, and these companies, instead of doing buybacks, maybe would have spent, I don't know, out of the $100 billion this year, $5 billion in research. Maybe that could help humanity advance or something, but it's crazy. That is crazy. After this is the Tim Cook effect of Apple. He created a major amount of wealth, but then there are no product pipelines left. So Apple is a mature company, maybe going to a declining one, and that's my opinion. So when we look at the market, despite beating the expectations and the massive capital return program, Apple stock declined following the report, dropping approximately 2 to 4% in after hours. And the negative reaction is primarily due to investor concerns on tariffs and the lack of Apple intelligence or the perceived usefulness of it, and the stock's relatively high valuation. I feel the best of Apple is behind. When Buffett sold Apple, I think he made the greatest decision. And yeah, so it's just so disappointing seeing this from Apple, a great company known for its innovation, to die down like this slowly by 100 cuts. Anyways, so this was the market overview for the last week, and I hope you found this interesting. I did talk a lot and it was very information dense, and I'll try to make it more interesting as we go forward. Let me know what do you think. If you want me to improve or add anything or subtract anything, I would be very open for the feedback. Maybe I should work on my monotonous voice. That could also be a point. But yeah, this was fun. So it's only 20-ish minutes, and I expected 30 minutes. So, okay. So like, share, subscribe, whatever. And yeah, I'll see you in the next one next week. See you.